Who would have guessed 2 weeks ago that we would be where we are today? Lots has changed for all of us. And I don't know if you're working from home or if your business is considered necessary for you to go in, but we know your time's valuable. We don't want to waste it tonight. And thought we'd just jump right in. I'm JD Tomlin, and I started the Tomlin Team Realty Company about 10 years ago. And a little late in the game when it came to what I wanted to be when I grew up. So I started in almost my mid 40s in real estate. Prior to that, I like to tell people I was in public relations because it freaks some people out to say that I was a pastor, and then other people totally get it. And so, I had the privilege of over about 18 years of being both in Keller, which is the north side of Fort Worth, and then Frisco for the last 15 years on the north side of Dallas. And over that time, we have raised 4 kids, and Heather and I, as homeowners, we live in our 3rd home since we've been married for 25 years. And so this being the longest home of 15 years. So when we think about being a first-time homeowner, they come in all shapes, sizes, and ages. Tom, you've seen 18-year-olds buying their first home, and we've seen 45, 50-year-olds buying their first home. And so regardless of where you come from in life, what we want you to know today is this. You're paying a mortgage already. It's either someone else's or it's your own, right? So if you're living in an apartment or a lease house, or you're sharing a place, you've got a bedroom with 3 or 4 other roommates, you are paying a mortgage. It's just putting money in somebody else's pocket. Our goal tonight is to start you on a plan for how you're putting the money in your pocket so that one of the greatest investments that you'll ever make would be in the ownership of a home. Just a quick snapshot. Most people today that have owned a home, and let's just say Dallas-Fort Worth area, don't know the Amarillo market real well, but I know that it has improved just like everywhere else. If you bought a home in Dallas-Fort Worth 10 years ago for, say, $200,000, today we are likely selling that home for about $300,000 to $325,000. So a 10-year investment of earning $100,000 to $125,000 when you only probably put $25,000 to $30,000 down at the most is not a bad investment. And so we find that home ownership is a great decision in one place of many to diversify not only income and opportunities to earn money off of equity, but also it's the American dream, right? Everybody wants to own their own home someday, and even other homes potentially as investment properties. Maybe just helped a family the other day. This is kind of fun. A young couple whose wedding I performed a couple of years ago. We sold their home. We're selling the wife's parents' homes, and they bought an estate together that has 2 homes on 2 acres with a gigantic swimming pool, tennis courts, huge oak trees, and it's just a beautiful, beautiful resort, basically. And mom and dad, grandparents can be there to help raise their grandson. And now, don't know about you, I like my parents being about 3 hours away, love seeing them when I can, but some people just love the idea of having multi-generations in one place. But, if you're a single person or a married person, or if you have children, no children, the opportunity someday to own a home is a big, big deal. And it's one of the largest investments that you'll make. And so we just want to give you some really easy on-ramps tonight of what it means to prepare for that and what the next steps would be. Some of you said you're a couple of years away from doing that. Somebody else may be 6 months away from doing that. Perhaps you own a home and you're ready to move up or move down or change towns that you may be moving to. We just want to give you some quick, easy on-ramps. So one of the simple first things that you'll do when it's time, and we're going to share, by the way, a resource with you that Brittany will email out to everybody at the end of this call tonight. And it's you're not seeing it like I'm seeing it, but it's your guide to buying a new home. And in this little booklet, everything you need to know will be in there. So we're just going to do a little flyby tonight. One of the things that and by the way, if you're willing to, if you want that a resource, just use the chat feature, and you can either type in your email address to everyone, or you can click just Brittany's name if you don't want everyone to see your email, and Brittany can be the person to see it. And so either way, you can just share your email tonight. We'll make sure to get this out to you. But you're going to want to meet with a real estate professional. Hopefully it would be one of the people on the Tomlin team here. Brittany obviously is the host. We're here to support her. So Brittany would be your point of contact as a real estate professional. Just have the conversation. I want to buy a home someday. We'll start preparing you, and we'll make some key introductions. One would be to Tom Sherman at Benchmark Mortgage. That's why he's on the call, and you'll hear from him in a few minutes to what to do to prepare from using a mortgage, which what's the percentage, Tom, of home buyers that use a mortgage? At least 90%, I would assume.
Oh, at least, yeah. 95%.
Yeah, so the large.
And in this demographic, almost 100%.
Absolutely. It's pretty rare for someone to pay cash for a home, especially a first-time home, unless somebody left you a sweet few million behind. And if so, I'm adoptable at 53 years of age. But nonetheless, you'll meet with a real estate professional. You'll have some conversations. They'll start giving you some thoughts, and then they'll introduce you to the lender. In our case, would be Tom Sherman at Benchmark, to get what's called pre-approved. Pre-approved is Tom looks at your income, he looks at your debt, and a really good mortgage lender, or what we call a financial advisor, when it comes to the mortgage side. A really good one is not going to try to get you into the biggest house in the world. They're going to try to help you save resources, live modestly so that you can pay off some debts, maybe student loan, credit cards, whatever, and still live comfortably. And so our goal, a good lender's goal, a good financial advisor's goal, is to help you make really good, sound financial decisions when it comes to your home purchase. And then we'll start the home search. Once we've identified what you can afford, it's really be a little bit premature to go look at $1 million houses if you can afford a $300,000 house. So once we know what you're approved for, then we actually have an app that we partner with Benchmark Mortgage that we would prefer that you use rather than Zillow. Now, I know if I asked you to raise your hand when you look at houses, I bet everybody would say Zillow. That's perfectly fine. It's a good platform. However, it's usually outdated. Most of the information in there is not always accurate. And so we've got an app that updates with the MLS, I think every 15 minutes, maybe even quicker than that. So you're getting real-time data. And so we would provide that app for you so that you're searching for homes on that app. And then when you find homes that you like, you let us know simply by making it a favorite, and it notifies us. You don't have to text, email, call. It just lets us know. It communicates, interfaces with both of us. And then we start going and looking for houses. Ideally, a really good realtor is going to know what you want. They're going to know the market, and they're going to take hundreds of homes down to 5 to 10 houses max. And we know what you want. We go look at them. We don't need to go look at 50 or 75 houses. If you do want to go look at 50 or 75 houses, I ain't your guy. But I will tell you that a really good real estate professional finds out what you want, knows exactly what the neighborhoods are like and the schools are like and crime rates and all that stuff. And then we help it really narrow it down so that when you go look at a few, it's easy to make a decision. In this market, if you go look at a bunch of houses and you go back to the one that you really like the most, it's gone. In this day and age, the good houses don't sit around long. So that's why it's important and imperative that we know exactly what you want. When we do our consultation, we'll find out all your needs and desires and wants, and then we'll find you the house. Once we make an offer and we negotiate the contract, we find an agreement between a seller and a buyer. You being the buyer, we go under contract, and then it's real simple. From there, now we got on the on-ramp, we're on the freeway, we're picking up speed, and the final few things are we do inspections to see what the condition of the house is, what needs to be repaired that we ask the seller to do. And then from there, it's on cruise control with the lender and his company to do, or her company to do all of the work to prepare for the final purchase. We call it underwriting and appraisals and all the things that take place that you don't have to worry about. So here's our job as the real estate professional side. Our job is to know what you want, help you find it, create the least amount of stress and worry, and provide the quickest on-ramp and the smoothest ride. And I like to use actually an analogy of flying a plane. It's our job is to get you out of the gate and to your final destination without any turbulence and on time. Just like Southwest Airlines, Brittany's husband, Jake Likens, works for. So it's a fun ride, and we can't wait to help you when it's time to help you. And if it's in Dallas, Fort Worth, if it's in Amarillo, if it's wherever it is, if we cannot be the agent for you, if you're somewhere other than the Dallas, Fort Worth market, we'll find someone that we really trust to help you because we want what's your best interest in mind. So trust us to help you find somebody if it's not in the Dallas, Fort Worth market. Make sense? So pretty simple on our perspective is just all you have to remember is the first step. Meet with us when you're ready, and then we'll take it from there. All right. How about any questions for me or for Amy or Larry on the real estate side?
I have one quick thing. So I logged in under JD's Zoom account. So if you're trying to private message me, if you'll private message JD, that will actually come to me. That would be great. And then also just for those of you who we are a little bit out from buying a home, I've put together first-time homebuyer tips that I'm sending out weekly over 10 weeks. And that will just kind of walk you guys through like what to be doing now to prepare well for your future. And it kind of breaks down a lot of what JD talked about into tangible steps you can be taking now. So if you've sent me your email address, I'll go ahead and get you subscribed for that 10 weeks of first-time homebuyer tips, as well as sending over that first-time homebuyer guide.
Love it. Thank you, Brittany.
JD.
I think it's Landry's turn now. I'm sorry, Heather, go ahead.
Okay. Yeah, just one little thing. Most of you probably know this, but in case you don't, a realtor's services to buyers is free. So the seller pays the realtor's fees, and I think a lot of people are just not aware of that. And so it really does not cost you anything as a home buyer to use a realtor, and it's such a wonderful service. So I would obviously highly recommend it.
It's a great reminder, Heather. And another reason why it's important to have your own realtor is because when you're represented by what we call a buyer's agent, we work simply for you and solely for you. We have your best interest in mind. If you probably maybe have called on the line before and said, how much is this property? Maybe even say, can I take a look at it? Well, the agent that's selling the property for the seller looks out for and represents one person, and that's the seller. And so you're not going to get representation. You're not going to have your best interest at heart from the seller and the listing agent. And so, yes, that's why it's important to have an agent working for you on your behalf, and it costs you nothing, which is a bonus. So very good.
Hey, I'd say one thing too on that, JD. It's a good point, Heather, is same thing goes for new construction guys, because I hear that a lot, especially with first-time home buyers, because they're like, why do you need an agent? Because they do have an agent in the office. Going back to what JD said, those people represent the company they work for. So our job as agents is to represent you. So keep that in mind as well as you guys are on your path to home ownership, whether it's something that's pre-owned or new construction, that you do want your own representation. Hopefully the Tomlin team, but definitely somebody that will represent you well.
And in addition to what Amy just said, a new home builder has a marketing budget that they use to pay realtor fees. And so they don't up the price of new construction. You don't eat that cost, which is, before I was in real estate, that's what I assumed. So just so you know, the price does not increase if you use a realtor for new construction.
Yeah, good point. Good point. Any questions that anybody has just from the real estate perspective before we hear from our financial guys? Any questions at all? So here's something that I know that they will reiterate. Tom especially will reiterate this. There's a misunderstanding that a home buyer would have to have 20% down to buy a home. If you've ever heard that, that's not true. There are many, many loan options out there. And I'm not going to steal Tom's thunder. I know Tom will speak to that, but you can get into a home for very little down. And so just don't think that you've got to save up for the next 5 to 7 years to have 20% down to buy a home, because that's simply not true. So Tom, I know you'll get to that in a little bit. All right. Any other thoughts, comments, questions? Okay, Landry, I think you're up.
Awesome. Well, it's been a crazy couple of weeks, huh? I'm so glad that we're still getting together and doing this over Zoom. At 49, we have been doing things virtually for, I guess this is going on our second week now, and I'm sure all of you are dealing with that in your own ways. But anyways, thank you guys so much for being here and being on the call. We're glad to have you. So like I kind of mentioned earlier, we at 49 are just passionate about helping people to find that financial peace. And so we do that through a variety of ways, whether that's insurance, investments, retirement planning, college planning. We kind of have our hands in all the different baskets as far as that goes. And I'll let Kyle kind of cover the rest of the areas that we work in. And so just so you guys know, Kyle is actually the founding partner of 49 Financial, and he's the managing partner up in Dallas. Our headquarters is actually down in Austin. And so he's just got some great experience. And then as far as buying a new home goes, we just have a couple of tips and just things that you can do financially in order to prepare for that. And so Kyle, I'll let you take it away.
Yeah, thanks, Landry and JD and the whole Tomlin group. Thank you so much for allowing us to join you guys. Real quick, as I mentioned a little bit earlier, I'm gonna cover two things. Number one, just some high level stuff, and then I'll cover some very basic stuff that we walk through. But we work with people at all steps of life, and I think, Heather, you said, well, there's a misconception that it's going to cost me money to engage with a real estate agent. The reality, that's not the case. And there's also a misconception, I have to have hundreds of thousands or millions of dollars to work with a financial advisor. And that's not necessarily the case. And that's certainly not the case insofar as why we are convicted behind the work that we do. So I wanted to show you something. I'm going to share my screen that speaks to that. And this is, let me get over here. This is something that we put together. It's called our Financial Foundations. And so our Financial Foundations is all about us helping our clients build a solid foundation from which to grow upon as it relates to, just navigating their financial futures. And there's some statistics over here that's things that you're probably familiar with. And we see it all the time, whether it's a young family just getting started, or it could be someone who is, more mid-career. People are living at the edges of their limits on very little margin, and by and large, people have not, taken steps to prepare themselves for that rainy day or for the unknown. And unfortunately, we're seeing even some of that in today's market, right? And so this is all about us helping folks exercise good fiscal discipline and establishing good habits before we even get into any sort of advanced sort of investing or planning around, some of the bigger ticket items. And so I'm not going to go into all of this, but this is our Financial Foundations program. And I just wanted to share this with you to debunk the belief that, I've got to have, a ton of money in an old 401k or lots of money just lying around before I can engage with a financial advisor. For us, it's not about that. We want to help people whatever stage of life that they're in, and certainly that applies to folks before they even begin the journey of preparing to purchase their first home. The other thing that I'll share with you real quick is just some very basics that we talk people through. And you notice I pulled my iPad up here. my wife and I have 5 children. And so for me, I explain a lot of things when it comes to through drawing. And so even when sitting down with clients, I whiteboard quite a bit. And so for us, when it comes to some basic foundational, solid financial planning principles, we think of things in terms of the establishment of various buckets of money. And again, this is very applicable to whatever season of life that you're in. And as we start, it begins with what we would call your 0 to 12 month bucket of money. And that is your emergency reserves. And so step 1 for us is sitting down with someone, helping to establish a budget, helping people to know where their money is going, and then beginning to establish good habits. And it doesn't have to be a lot of money, but establishing good habits of establishing an emergency reserve bucket of money, so that when the unexpected happens, they're not in a position where they have to go put a lot of those unexpected expenses on credit cards or high interest loans that can really undermine their financial future. So it begins with a budget, and then it moves to establishing emergency reserves, establishing good saving habits, and then from there, we push further out on the time horizon, 1 to 3 years. That bucket of money is going to look a lot different insofar as what we encourage people to do, and then kind of the 3-year plus dollars that we'll be thinking about entirely differently. And I start here because this is a very kind of scalable, very simplistic model, but very profound model that we utilize when we're sitting down and we're talking to clients and prospective clients, because we want to help them prepare for a major purchase like a home, which I 100% agree with what JD said earlier. For a lot of reasons, real estate represents a phenomenal investment, whether that be your primary residence, rental properties, whatever it may be. Many of our clients are heavily invested in real estate, but we want to establish some basic foundational principles by which we can filter decisions as it relates to and prepare you for that major purchase. And so, as much as anything, I would just tell you that we don't believe there's a one-size-fits-all solution. We believe that money applies to every individual, every family a little bit differently, the way they engage with money, the way they think about money. And so we believe in a highly relational approach. We want to sit down and establish some really good foundational principles, and then allow those principles to inform, what is the right amount of house for them? What is the appropriate amount of kind of monthly expenses to expect as it relates to a purchase like that? And how does that fit into the bigger picture? And we're passionate and we're convicted by that process. The last thing that I'll say is, as someone begins to step into the decision of purchasing a home, and you have more people in your life that are dependent upon you, we believe that is a very important time to consider your life insurance portfolio, and that's another kind of protective measure when it comes to financial planning that really does not cost very much money at all. $20-$30 a month for young people to get an appropriate amount of life insurance to cover that liability should something, God forbid, happen to them. And so that's another topic of conversation we begin to enter into as it relates to starting taking on the responsibility of a home. So those are some of the basics. Those are the types of things that we think about as someone is engaging with us and getting prepared for what is an incredible experience and an incredible investment. So that is about all I had. Landry, anything else you want to cover, bud?
I think you hit all the bases, man. Thanks so much for doing that.
You bet. Let me stop sharing my content here.
Do y'all have any questions for Kyle or Landry?
That was great. Thank you, Kyle. I just got to learn how to get a little whiteboard on my iPad like that. That's kind of cool.
Yeah.
Fun. All right. Good stuff. Well, again, at the very end, we'll do an open Q&A. You may think of something that we can come back on. And again, you can also feel free to use the chat feature. And now let's go to Tom Sherman.
Yeah, thanks guys, and all great info from all of you. It's funny, as I'm sitting here thinking and listening to all this, it reminds me how often people decide to do something, and instead of thinking about it and planning about it, they just jump and decide to do something, and then they wish they had done things differently. And if I look at the people on this call, you know, you've got Kyle, who really is where it should all start, Kyle and Landry, and that's really kind of getting a handle on where your money's going and how you're spending it and what to do with your future. And then you talk about getting qualified, and then you start talking with the agent to buy the house. And I'm sure you guys can all imagine, in most cases, it goes the other way. Most cases that someone walks in and says, I want to buy a house, then they call me and say, hey, do I qualify for it? And then after that, they sit down with Kyle and Landry and say, hey, are we ever going to be able to hit our financial goals? And then we're all trying to backpedal and fill in behind everything. So you guys are doing it the right way. A couple things I want to hit on that are really important. And I like to talk about things in from the perspective of a target. And I like to say, we're first going to get you on the target. And that's helping you understand the entire mortgage process and understand the qualification process. And we go from getting you on the target to you personally, how you personally actually qualify for a home and what you actually qualify for. So the target is really understanding the mortgage industry. And it's very interesting in today's market to understand it, because you guys are experiencing something or probably hearing about something that has never occurred in the mortgage industry. And I've been doing this, like I said, 26, 27 years, been through several cycles. And what's happened in the mortgage industry in the last 2.5 weeks has been unprecedented. Give you a little history of what happens in the mortgage business. And a lot of people don't really understand where the money comes from. So it's important to understand the flow of that money. But if you think about it, you've got companies like mine that originate a mortgage loan, and we'll do roughly $5 billion a year in mortgage loans. We don't have $5 billion that are sitting in our bank accounts, okay? And so what ends up happening is we originate a mortgage loan, we borrow against a warehouse line that we have, we then fund those loans, we then sell those loans to an investor who then packages those loans and sells them on the secondary market through something called mortgage-backed securities. And that's how the flow of money works. And so what ends up happening is the investors that are underwriting mortgage-backed securities are turning around buying mortgages based on the risk and rate of return that they're looking for. That goes all the way down through the banks and the investors and ends up with someone like myself originating a mortgage loan. And it just goes around and around and around. What's happened in the last couple of weeks, however, is that the end investors who were buying mortgage loans were really wondering if they should buy those mortgage loans because they couldn't determine what the risk level was that they wanted on those mortgage-backed securities. And it created a little bit of a liquidity, not a little bit, a significant liquidity crisis in the entire industry, to the point that a couple of weeks ago, we started hearing talks about the government getting involved, and which they did last Friday. They started buying mortgage-backed securities, and they're continuing to buy mortgage-backed securities today. What does that mean? Basically, what that means is the government has said we're going to continue buying mortgage loans regardless of whether any investors show up. So that's great news for our economy and great news for the mortgage industry. The question you have to ask yourself is why? Why does the government care so much about the real estate and mortgage industry in the United States? So I'm going to give you a little interesting statistic, and I heard this from Dr. Ben Carson this morning. And this is something you want to write down. But the average homeowner in America has a net worth of approximately $200,000. The average non-homeowner in America has an average net worth of about $5,000. So the question you've got, now it's a little bit of a difference, right? 200,000 to 5,000. So the question you've got to ask yourself is what happens in the United States if all of a sudden the mortgage industry gets hammered? And the answer is obvious. It significantly impacts people's net worth. So when you understand that, you realize that's why the government had to get involved and really start buying mortgage-backed securities. All of that, very interesting, but probably doesn't mean anything to anyone who's actually looking at buying a house. So when we look at the industry, we look at it and we say, okay, well, how do we explain this to a consumer who's calling in and saying, hey, what do I qualify for? Well, you have to know a little bit about this market so that you can explain that. And what's fascinating to me is most people just want to know, they want someone to tell them, hey, what do I qualify for? And the easy answer is I can ask you 3 questions and determine what you qualify for. But the bigger question, and we're going to get to those, but the bigger question is, what can you afford? Honestly, that question is the one that nobody really asks. And I think it's the most important question that people need to ask. What I encourage our clients to do before they ever even start looking at buying a house is create a budget. And if they haven't created a budget, that's the first thing you got to do. You've got to figure out where your money's going and where you want your money to go. Once you've created a budget, you have a really good idea of what you're going to be comfortable with spending on a house. And so then once you know that number, then when you come in and talk with us as a lender, you're fully aware of what you're comfortable spending, and it's really irrespective of what we're going to tell you you actually qualify for, okay? But there's 3 things that we're going to look at when we're determining what you qualify for. And you can write these things down. We call them the 3 C's, okay? So the first thing we're going to look at is your cash. We're going to look at how much money you have for a down payment. And JD was right on when he said the confusion that a lot of people have is that they have to have 20% down. Now, obviously, I wish everybody did have 20% down, but the reality is the vast majority of people don't have 20% down. So that's the first thing we're going to look at. We're going to determine how much money you have down, and that's going to help direct us to what type of loans are available for you. The second thing we're going to look at is your credit. And we're going to spend a little bit of time here because it's actually, with some of the news that came out today, it's actually really, really important to understand credit. But credit is basically your ability to repay debt. That's all we really care about. When a lender looks at a borrower's credit, they're looking at the borrower's ability to repay that debt. And we're going to drive, most of that's going to be driven by what your credit score is, okay? So there's a lot of stuff out there that says, well, credit score is not that big of a deal anymore. But the reality is it's actually a huge deal. And we'll get into a little bit more detail on that in just a minute. The third thing we're going to look at is your capacity. And the capacity is going to be basically your debt to income ratio. We're going to look at how much money you have coming in, and then we're going to look at how much debt you have. And we're given certain guidelines as to how much debt to income ratio you can actually have. Okay? Now, what's fascinating is if you go back prior to 2007, what was going on at that time was these guidelines were basically thrown out the window. What I mean by that is if you could fog a mirror, you could get a mortgage loan. And it was a really dark time in our industry. Anybody who was in the financial industry at that time would remember it. If you're interested in knowing what happened, go watch the movie The Big Short. Since we're all on quarantine, not a bad movie. It's better to watch The Big Short instead of Contagion, by the way. But definitely watch The Big Short. But what happened at that time, lenders were heavily participatory in giving loans to people who could not qualify for those loans. There was actually a loan out there called the no-doc loan, and that loan meant we didn't verify income, we didn't verify assets, we didn't verify a job, we didn't verify where your money came from. We usually would take a breath, sample, make sure you were actually breathing, but that was about it. And what was happening is all these loans were being bundled together, sold into the secondary market, and they were all being sold as a similar risk level. And so if you can imagine, the person who actually qualified for a loan was being coupled with the no-doc loan, and it was sold as the same risk level. And that came crashing down in 2007, and the government finally came in and said, we're going to change that. We're now going to create guidelines and standards that everybody has to follow. And that way we can know the actual risk category that a borrower has. It brought us into the 3 C's, which is where we're at today. So let's kind of break those down, and I want to talk a little bit about the different loan programs that are available under each one. And the type loans that we're going to be discussing are, and you might want to write this word down, but they're called qualified mortgages. And when the government took over in 2007 and instituted all kinds of good guidelines for lenders, they created qualified mortgages and non-qualified mortgages. And the best way to understand that is qualified mortgages are insured by the federal government. Non-qualified mortgages are not. Well, why that's important is that non-qualified mortgages are basically individuals or institutions that lend their own money, and they set the risk categories for that money, and they're totally on the line for 100% of that money. If the loan is insured by the federal government, basically we as a lender just follow the federal government's guidelines, and in the event that loan goes into default, the government has that loan insured. That's the best way to look at it. And so the only loans that I think it's about 75 or 80% of home buyers will only use qualified mortgages. So those are the only ones we're going to look at. There's 3 primary types of qualified mortgages. And you've heard these terms all over the news here recently, but you have conventional loans, you have FHA loans, and you have VA loans. Okay, so let's kind of walk through each of those. The first one is the VA loan, and the VA loan is 100% financing. So no money down. You can have credit scores as low as 640, and you can have a debt to income ratio as high as 50%. Okay. It's definitely one of the easiest loans available, but well, let me put it this way. In order to qualify for that loan, you have to have served in the military. So if you haven't served in the military, that loan is not applicable. If you have served in the military, that loan is by far the best mortgage loan available in the market. The second type loans and the third type loans are the FHA loan and the conventional loan. And it's important to understand what those 2 loans are, because a lot of people don't really understand what that is. But the FHA loan is a federally insured loan. It's federally insured by the Department of HUD, and it was designed as a loan for first-time home buyers, okay? And so if you think about the demographic of a first-time home buyer, you typically are dealing with a borrower who doesn't have a large down payment. You're typically dealing with a borrower who may not have as high of job security as someone else might have. And you're also dealing with someone who probably doesn't have the same level of credit history that other borrowers would have. And so what was happening is the conventional lenders were basically not doing first-time home buyer loans because they were too risky. And so the Department of HUD came out and said, well, what if we insured a loan that was more applicable for first-time home buyers? Lenders said, hey, great, if you're willing to insure it, we'll lend those loans. And that brought out the FHA loan. And so the FHA loan will actually let you get into a house with 3.5% down, okay? It also has mortgage insurance on that loan. We'll talk a little bit about that here for just a few minutes. But it has mortgage insurance that is paid monthly, and it has mortgage insurance that is paid up front and financed into the loan, okay? So what I like to tell people is the FHA loan is less money up front to get into, but it is more money over the life of the loan. So it actually is a more expensive loan. It's just less expensive up front, okay? The third thing that FHA is really focused on is credit, and it has much more lenient credit guidelines than a conventional loan. In fact, if you look at a conventional loan, you really want to have a 680 or higher credit score. FHA will go down to a 580 credit score. So basically, the FHA loan is designed to really give people a get out of jail free card, if you will. If you had a mistake on your credit or you had a a hiccup on a late payment, or something happened that was a derogatory, FHA is there to save the day, if you will, and help you get into a home. So the third loan is going to be the conventional loan. And the conventional loan is issued by Fannie Mae and Freddie Mac, is the names you're probably familiar with. Fannie Mae and Freddie Mac actually insure those loans as well. And Fannie Mae and Freddie Mac were originally and still are required to issue loans that were 80% or less loan to values. So the original conventional loan was 20% down. And what was interesting is, as conventional lenders were noticing that FHA loans were performing pretty well, this is years and years ago, they actually brought out their own mortgage insurance, which allows someone to get into a conventional loan with as little as 5% down. And if you're a first-time home buyer, a conventional loan will let you get in with only 3% down. So if you think about it, you now have a conventional loan that's designed for first-time home buyers with 3% down. You have an FHA loan that's designed for first-time home buyers with 3.5% down. And of course, the VA loan with 0% down, okay? So the obvious question is, well, why would someone not go with a conventional loan that had 3% down instead of an FHA loan with 3.5% down? And the answer is that the 3% down conventional loan has a lot more guidelines and a lot more, really has a lot more strings attached to it than a conventional loan has. It's much more limited on your income. You have to make less money. It's actually much more limited on your credit. Your credit score has to be much higher. And it actually is much more limited from a debt to income ratio as well. So it eliminates a lot of first-time home buyers simply because they don't qualify for that loan, okay? So again, we're gonna look at the 3 C's, your cash, your credit, and your capacity. And I wanna now kind of go down to more of the bullseye, which is each of us individually, and look at each of those numbers from a personal perspective. And feel free, anyone wants to call me after this, I'm happy to go through detailed numbers personally, but I'll kind of walk through a scenario so that you can see how we come up with these numbers. So when I'm talking with the client, the first thing I'm going to ask them is, how much cash do they have available for a down payment? That's a really important question, because we're going to watch where that money comes from very, very closely. So if that money is a gift from a family member, that's going to put you in a different type loan than if it's money that's in your savings account. If that money is cash under your mattress, we're not allowed to use it. So there's a lot of things that we want to find out long before you actually start looking for a home, so that we can address those things. It's amazing to me how many clients will call me and say, hey, I wrote a contract on a house, and we asked that simple question, and literally I've had everything from, Tom, I'm getting a bonus next week and I'm going to use that money for my down payment, to, hey, I've got cash coming in, to, I actually have had people say they were selling. My favorite one was a guy sold his yacht to get the money for the down payment. And we actually had to get a bill of sale and an appraisal on his boat to get the down payment money. But we need to know where that money's coming from, and the sooner we can figure that out, the better. Once I know what percentage that's going to be, then I'm going to immediately direct the loan either to conventional or FHA. The second thing I'm going to ask is, what kind of credit does a borrower have? Again, that's a really big question, because in most situations, people are going to give me an answer like Credit Karma says my credit score is X, or my app on my banking app says my credit score is Y. And while those are good indications of what your credit score is, they're not necessarily the same credit score that we're going to get when we pull the mortgage score. So we want to we want to do an application really quickly, and we want to check someone's credit score as soon as we can. When we do that, our team is going to look at the score, and if there's anything we can do to improve that score, we're going to guide you through that process immediately. The reason is that your credit score is the biggest determining factor of the interest rate that a consumer will get. So if you've got a low credit score, your interest rate's going to be higher. And so if we can get your credit score up, we can actually get you a better interest rate. The third thing we're going to look at is how much outstanding debt you have and what your actual income is. Now, that's really, really important as well, because as we're looking at someone's debt to income ratio, how they're paid, what kind of income they have, what kind of debt they have, what the required payments are. All those things can significantly impact a borrower's ability to repay a loan. The reason this is important, and especially when you're dealing with first-time home buyers, is a lot of times we find consumers and first-time home buyers will make decisions that they think are better for them and very well might be better for them in the long term, but in the short term can significantly impact their ability to qualify for a home. So let me give you an example. Let's say you're currently on salary and your boss comes to you and says, hey, you're great on the phone, you could really do sales and you could do really, really well. And you say, hey, that sounds great. And the boss says, well, hey, the only catch to that is we're going to move you from salary to commission, but you should double your income. And you say, okay, that's great. So you switch from salary to commission. And sure enough, first month, you double your income. You think everything's great. And you say, hey, I'm now ready to buy a house. And you pick up the phone, you call me and you say, I'm ready to buy a house. And I say, great. How are you paid? And you say, well, I get paid commission. Well, the first question I'm going to ask is, have you received that commission for 2 years? And if the answer is no, we can't use any of that commission income in your qualification. Okay, so that's a big, big, big thing. Let's say another situation where you've got different sources of income coming in, whatever that might be. We get tips or we drive Uber or whatever other sources might be. Anything that does not have a 2-year history on it is going to be underwritten much more aggressively than those things that do have a 2-year history. So again, all of that begs the question, why would you not get interested or get in touch with your lender sooner than later? Because every one of those things can impact your ability to qualify for a house. Another big one that comes up a lot of times is people will say, hey, I took on a new debt and I hate having debt, so I made sure that I'm paying my debt off really, really quickly. And so my new car payment, I'm paying off on a 3-year note instead of a 5-year note. While that's definitely advisable from an interest savings, from a qualification savings or qualification standpoint, that actually hurts your ability to qualify for the house you're looking to buy. So all those things are super important. What I tell people to do when they're getting into the process of buying a house, get in touch with your lender immediately, get in touch with your financial planner immediately, and start thinking about these things long before you actually say, hey, I'm ready to pull the trigger on a home. And if you do, it'll save you a lot of pain and a lot of struggle. So that's a lot of information, Brittany and JD, but I definitely wanted to get all that out. Any questions?
Tom, mention, those that have credit cards, which probably most on this call do, when you get your statement at the end of the month, let's say that if you wanted to pay the card completely off and it was $2,000 to do so, or if the statement balance was $1,000, what do you recommend right before purchasing a home, especially from either paying that credit card off completely versus the statement balance? Do you want some money still left on that card when you're running credit?
Yeah, that's a great question. And it's one of the things, JD, that I deal with a lot, because you answer that question differently depending on what your goal is. Okay. So if your goal is, I want to get rid of interest costs, the best thing you're going to do is pay off your credit card. The problem with that is that if you do that, you now have the car payment, which significantly impacts what you actually qualify for. Okay. So what we like to do is figure out what the client's goals are first, and then help strategize what the best step to make is. As far as paying off a credit card, if you're trying to simply keep your credit score going in the right direction, the best thing to do is always keep a small balance on that card. Typically, there's different ideas, but I like to say less than a 10% of the available credit. You don't want any more than that on that credit card. So if you have a $10,000 limit, you want to keep a balance of about $1,000 on that. And obviously you want to pay it off as fast as you can. I'm a firm believer in not having credit card debt in your grand scheme and grand plan. But initially you want to keep some revolving debt being paid.
Awesome. Does anyone have any questions for Tom while we're all together here?
I have one question. So in our case, it's a little different. We don't have a credit card quite yet, so we don't know how would you go about getting a better credit score, or how that work?
Yeah, Connor, that's a really good question. And it's ironic is that there's a lot of people out there that are teaching not to have credit cards.
Yeah.
And I would say for most people, that's probably really, really advisable, because credit can be such a major negative in someone's life. I mean, I've seen a lot of people just destroyed by credit. So if that's the goal, and if the goal is to be as debt-free as you can, which I think is a preferable way to do things, then I suggest getting a secured credit card at your bank. And you simply, whatever it is, you put $1,000 up, and that's how much your credit limit is. If you spend more than $1,000, that credit will be denied. And now that'll help you build a credit score. And that's really important, because initially when you start out with a credit card, your score will actually be lower.
Right.
So for example, if you said, hey, I'm trying to buy a house in June and you don't have any credit, and you go get a credit score, we're going to pull your score up. And because you don't have a history of paying that credit, it'll actually hurt you. So you want to have at least 6 months of credit history on your report before you start looking at doing anything. Now, there are some interesting things out there right now. Experian has actually been really pushing this, and I've seen it hurt a lot of people. It's helped some people as well. But they're allowing you to create a credit score by turning in other debt that you have that may not be being reported to the credit bureau. So I turn in utility bills, or I turn in insurance, or I turn in anything else like that. Well, the problem is they're still looking for a history. So if you turn in a utility bill for the last 3 months, that actually doesn't help you. That actually would hurt your score.
Good question, Connor. Anybody else? Good information today. I hope this has been helpful for everyone on this call. And Landry, any questions for Landry, Tom, ourselves? We don't want to cut this short. We don't want to keep you from catching your favorite 7:30 p.m. show either. I forget there's DVRs out there though. So
And Netflix, you can watch anytime you want now. It's crazy.
that's right. Not everybody pays a high cable bill like me, huh? Anything?
So one thing I would just encourage everybody to do, and it's hard to do, and I'm just going to, shout out for Landry for just a minute, but meeting with a financial planner I would argue it's the most important financial step that you're ever going to make. And the reason is that having that accountability and having someone else ask you those tough questions helps change the trajectory of everything you'll ever do. And it's amazing to me, and I know JD and Heather and Amy and Larry would say the same thing, and Brittany, but the number of clients who will end up buying a house and at some point in their life regret that they bought too much of a house is amazing to me. And it never would have happened if they had someone asking the right financial questions initially before they actually made that decision to buy.
Yeah, thank you so much for saying that, Tom. And I would just love to drop my contact info here in chat if anyone would like to talk. Kyle had to step out, so sorry about that. He had another meeting to get to. Okay, I just threw my number in there. Please just shoot me a text or give me a call if you guys have any questions. We are, like I've mentioned a couple times, we're super passionate about just laying the groundwork for people so they can get to make these decisions like buying a home down the road at some point. And we have a foundations program that Kyle mentioned earlier that we would love to sit down and chat with you guys about and just get the ball rolling and get things started on the right foot so that you don't regret buying too much of a house somewhere down the line. And it's all about planning, right? It's all about just getting those things out out of just kind of thinking about them and wondering about them and actually into practice. Because a lot of people, they believe that they know what they're doing or they have these ideas, and it's our job to just make those complex ideas very simple and put things into place. So anyways, if you guys would want to chat, I'm always available. My number's in the chat here. And thanks so much for y'all's time.
Yeah, and I'll be emailing out everyone's contact information that led the call today. If you sent me your email address, and if you haven't, feel free to go ahead and drop it. It'll be to JD Tomlin, and I'll get both the First Time Homebuyer Guide out there, contact information, and then I will subscribe you guys to our First Time Homebuyer tips that we have going out. So last thing I'll just say, almost a year ago today, my husband Jake and I were talking with JD and Tom, and we're like, you know what, we want to buy a home in 2 years. That's our plan. And they both were like, Brittany and Jake, like, why 2 years? Like, why that time frame? We're like, well, we think that would be a good point. Like, that's, in our minds, that just makes sense. And they're like, well, what will the difference be with 1 extra year of savings? We're like, honestly, not that much. We have our down payment saved up. We'd add a little bit. And they're like, what if we move that timeline up and just start looking now? And Jake and I talked about it, and we ended up, within 3 months of talking to them, we bought our first home. So we've been in our first home here in Dallas a full year now. And it has been the best decision. We've loved every minute of it. It has been one of the greatest joys, both in our life and our marriage, and also our dog Summer's life. So one of the main motivations, I won't lie, is getting Summer backyard. So that and just getting to host lots of friends over has been just the greatest joy. And having these guys lead us in that decision. And now it's been about a year for me being in real estate as well, and getting to learn so much about that and be able to help peers make such a wise investment to set themselves up for financial freedom in the future and the joys that all that life can bring. We're here for you guys, and we want to help make that a reality. So we'll be in touch for sure. And all of us are here to answer any questions at any point that you guys might have. So thanks for joining us tonight. We appreciate it.
Let me add one other last thing here. So between everybody on this call that I know personally and whose homes I've been in, if you're ever in downtown Frisco, I'm setting up Larry Cotton here. Larry and his wife Diane recently bought, what year was that house built in, Larry? Like 1910, 1920? Oh, you're muted, bud.
1922.
It's one of those beautiful, beautiful craftsman homes that sits in a historic part of downtown Frisco, a block from the Summer Moon Coffee and the Rail District, and it's a cool place. And so, your first home may be something like what Larry and Diane have, or it may be, in the suburbs. It may be down in the in the Art District. Who knows? Wherever it is, we want you to know that it's our Landry's and Tom's and the Tomlin team's goal to help you get into something that is not just affordable, but also something you're proud of and something that you love living in. And you've probably seen the quote by now, would this be a home that you'd like to be quarantined in? And it's a corny phrase that some realtors are using out there. But quite frankly, we're spending a lot more time in our house than we ever have. And you want to be able to enjoy that when it comes to that. And in a place that, and I will say this lastly, when Heather and we bought our first home, and again, Brittany's our daughter, and she has 3 younger siblings. Our very first home was 1,600 square feet with 6 of us living in it. And you can go to other parts of the world, and that's a mansion for some, right? There are some families of 6 or 8 or 10 that live in a 10 by 10 dirt floor hut. Whatever home is and whatever it means to you, it's a place of refuge for your family and for you, and a place that you're proud of. And it can look like a number of things. Don't compare to the Joneses. Don't compare to, somebody your age or that 10 years older that owns a 5,000 square foot house with a pool and 5 acres. Just start somewhere and let us guide you in making a decision that gets you on a good road to financial freedom. So Landry, thank you for doing that from your perspective. Tom, thanks for being our trusted advisor. And Tomlin team, thank you. But most importantly, guests, thank you for being on the call today. I hope this was helpful tonight for you. And we want to be a trusted advisor for you anytime, any way we can be. Hope everybody has a great night tonight, and we'll see you guys soon. Take care.
Thanks, guys.
Thanks, everybody.